Welcome, everyone. How's it going? I know an odd time for a stream, a Thursday 10 a.m. Pacific stream, but I wouldn't do it with anyone other than Mayur Attacker here, Fresh Jiva on Twitter. You've probably seen him on your favorite Tesla YouTube channels. If not, you've probably followed him on Twitter. If not, you should go and follow him. Link in the description. I'm happy to have him on his very financial, astute, accounting wise insights on Tesla in terms of where they're growing their valuation. And excited to have you on, Mayur. Thanks for coming.
Yeah, absolutely.
What's funny is we couldn't have timed this more perfectly. Like literally 10 minutes ago, and I'll share my screen just for everyone watching. 10 minutes ago, we got, let's see, let's pull it up here. There we go. Tesla has now been upgraded to investment grade credit, a triple B from a double B plus, on the note of improving production. What's your initial thoughts on this? I don't expect you to have read through the note or anything like that, but what's your initial thought on the investment grade upgrade, and do you think this matters?
Yeah, it does matter, but I'd say that it matters to a much smaller extent than what most people think. Okay. It's definitely good news, definitely not bad news. It's something that we've been expecting for a long time. Anyone that follows Tesla's financials knows that the company went from a absolutely horrendous balance sheet, very high debt and a cash burning situation at Tesla, to a very low debt and very high cash generating situation at Tesla. And yet, for some reason, the credit rating agencies were still stuck on keeping Tesla at, below investment grade, basically speculative rating, which never made much sense because considering some of the companies that S&P and Moody's actually has as investment grade have been in revenue contraction for years, have been in decline for many years, and yet they're still rated investment grade. And here's Tesla with rapidly improving financials and basically more cash than debt on the balance sheet.
Yeah.
So it's actually a long time coming. It's amazing that it took them this long to do it, but it's better late than never.
Right. And it seems like S&P and the weighting there, like I'm not sure if this is just me being weird, but it feels like the timing's off with this one, like in the middle of the day on a Thursday. Like I would have expected this after hours on a Friday. Could it be possible? I'm going to throw on my tinfoil hat here. There are some people going this route. Is it possible that Tesla, it might be issuing some sort of debt here, whether it be, for share buyback, or they don't need any debt? I mean, that's the only real reason I can think about here. Just the timing feels a little bit weird here, no?
Yeah, they've done this before. Sometimes these notes are released in the middle of the day, but yeah, you're right. It's typically done after hours, but
yeah.
But I don't think Tesla's going to raise more debt. I don't see that happening. Maybe they do for some reason. Maybe they have access to really cheap debt, but as of right now, interest rates have moved much higher. For all companies across the board, even for investment grade companies. So it doesn't make a lot of sense for Tesla to be borrowing money. For example, Apple doesn't need any debt at all, but they do tap debt occasionally. And it's because they can access that debt at very, very cheap rates. But this was before, though, not now. But investment grade credit has, taken a hit along with, interest rates being raised by the Fed. So I don't see, Apple or Tesla, either one of them, tapping the debt markets anytime soon, because the companies themselves are generating cash. So free cash flow has flipped, positive and growing rapidly at a rate of 40 to 50% per annum, depending on when Tesla elects to deploy more capex. So the company generates a lot of cash now, and they're about to step it up even further. I think when we get Q3 results in a couple of weeks now, we're going to see record free cash flow, I believe. That's just my estimate. And that's going to accelerate into Q4 and next year. So this investment grade credit rating is good news, but it really means nothing for Tesla. It doesn't change anything. All it changes is for certain investment management firms to now be able to buy Tesla stock.
Yeah.
That's all.
But given how high retail percentage is in Tesla of ownership, could that not be like, and of course we're separating fundamentals here from, if you even want to call it, like just short-term mechanics of the stock, right? But could that pool not be like massive, considering where Tesla is? It's unprecedented for an automaker to be at these record level of, and we're going to talk about it soon, a return on invested capital or free cash flow in the upcoming, let's say, 12 months here as Austin and Berlin ramp up. Could that not be like a very substantial group of portfolio managers now that might be buying the dips on Tesla, whereas they couldn't a week ago?
Yeah, it's possible. In fact, the person to follow about this is her name is Alexandra Mers. Her Twitter handle is at Tesla Boomer Mama.
Yeah, friend
She's
of the show.
yeah, she's awesome. She's been tracking this for a long time, and she thinks that it's going to be a pretty big pool. The only thing is that this just means that those firms that were previously restricted from buying Tesla stock can buy Tesla stock, but it doesn't mean that they will buy Tesla stock. This is not the same thing as when Tesla entered the S&P, where when they entered the S&P 500, everybody who indexes to the S&P 500 is required to buy Tesla stock. This is just, it enters their investment sort of universe. It enters their investable universe that they can pick from.
Yeah.
So that's all that means. But yeah, on the net, on the margin, yeah, it's going to create some incremental buying in Tesla stock. How much it moves the stock, I'm not really sure. I'm not, putting too much into that.
Totally fair. Yep. And let's get into that. You kind of hinted at that for a second here about Tesla Q3 deliveries and earnings report to come. What were your thoughts on, of course, the production and delivery kind of, don't want to say debacle, but it sounded like everyone kind of blew this out of proportion with the 20,000 car chasm between supply and demand, quote unquote. What was your reaction to that? And then what was your reaction to what the stock's done since?
Yeah, it's I don't read into it that much. Just as a long-term investor, data is lumpy. Sometimes it's all about timing, right? So those 20,000 or so vehicles that were expected to be delivered in the quarter is just simply going to be shifted over to Q4, because that's what they said in the press release. It said that they had a reasonable number of cars in transition at the end of the quarter, so they can't really. They're not allowed to record that as revenue and as deliveries just yet. So all it's going to do is do some, lead to some jockeying between, debit from Q3 and credit to Q4. So in the net, it's not going to change. It's just a matter of timing. The bigger thing to just keep track of is what is the primary trend, right? We see Tesla growing at 40 to 50% consistently every single year, both in production and in deliveries. So that growth rate is more or less going to remain for the foreseeable future. And whether it falls into Q3 or into Q4, it really shouldn't matter for long-term investors. Now, short-term investors, hit the stock on that news, thinking that there's some, issue with demand. And, I think they're slightly correct, because I'm in the camp that believes that Tesla is going to have to continue to cut prices in order to garner more and more, deliveries. It would be truly unprecedented for Tesla to be able to deliver, say 2 million cars at a $55,000 price point.
Right.
Not saying it's impossible, but we've never seen anybody do that before. So unless if the world just started getting richer, if everyone has a lot more disposable income now and can afford $55,000 cars, I don't see that happening. In the absence of FSD, so that's the X factor with all this. If Tesla can master with very, very high confidence full self-driving, and can achieve level 4 autonomy, that would change the cost dynamics, completely, because then people would be looking at this in terms of an ROI standpoint. And so that's why, if that happens, then it's possible. But as of right now, it's not ready to step in right now. just as we're entering, what's looking to be a global slowdown at the very least, if not recession.
Mm-hmm.
China's already slowing down. They've been in recession, especially because of COVID, those mandatory lockdowns that they've had. Europe has been in recession. They're struggling with energy prices. And the same thing is happening here in the US. And, I've been tracking that as well. So, in global slowdown, it's just hard to see, Tesla grow, at 40 to 50% at the current price point that they're at, in the absence of, level 4 autonomy.
Well, to be fair, I think the good part with that is prices are so much higher than they were at the end of 2020, let's say, for ASP for Tesla for almost every single model, especially like the Model Y. So even if Tesla does give back some of that price cut to consumers, it's nothing to worry about. So as long as they're not cutting it below what it was, let's say, end of 2020 when they started really dramatically raising up those prices again. Is that like a fair assessment?
Yeah, that's fair. Yeah, and this is not by force. This is out of design. There was a presentation that Martin Vieca gave to analysts, and we weren't privy to that. But what we do know is that he did mention that Tesla wants to move towards building that truly mass market vehicle at the $25,000 to $30,000 price point. That's the only way they're going to be able to achieve their long-term objective, which is to sell 20 million cars, right, per year.
Mm-hmm.
That's been Elon's goal for a long time. And, the only way they can do that is either by, riding down the cost curve as they continue to innovate on battery technology and manufacturing, as they continue to innovate on vehicle design to bring costs down, and passing those savings on to customers. That's the only way they can get that, $10 to $20 million annual, production and deliveries goal. Unless if they, again, master level 4 autonomy and suddenly customers have an ROI on, spending, 20,000, 25,000, 50,000 on, FSD software.
Right.
But in the absence of that happening, Tesla has to ride the cost curve down. And that's what they've been doing, right? Since, day one, their goal, right? Elon's master plan is to continuously provide more and more affordable cars for the masses.
Yeah.
And you can see that in, for example, their ASPs. I don't know if I can share my screen.
Yeah, you should be able to.
Just click on present screen. Okay, there we go.
Present, and then you should be able to.
Yeah. So, can you see my screen here?
There we go.
Yeah. So I just have, this chart that I tweeted out before, but this is just a Google spreadsheet. I just keep all my data in. But you can see that this blue dotted line right here represents the average selling price of Tesla cars. So it's just basically total automotive revenue minus their regulatory credit sales divided by total, cash deliveries every single quarter. And I summed it up into trailing 12-month, figures so that it adjusts for seasonality. So you can see that, back in 2014, Tesla ASP hit, a high of, I want to say 92,000 right there. And since then, they've been continuously writing down the cost curve, right? That was the introduction of, originally it was just the Roadster that was super expensive. Then they introduced the Model S, which was still expensive, but a lot more affordable than the Roadster. Then the Model X came out, which was roughly the same as the S. And then the Model 3 entered the scene, right, in 2017, 2018, especially, the last couple of years. And you can see that that's what really drove average selling prices down. Mm-hmm. And so that was only made possible because of innovation, right? Because of battery, economies of scale, as well as, continuous innovation on manufacturing. Even the factories themselves got more efficient, right? The cars themselves got more efficient with fewer and fewer parts. We know that the Model 3 was significantly more fewer parts than the Model S, and the Model Y is even fewer parts than that. And we know that Tesla did a lot with just innovating on how the vehicle frame is designed. It was, originally multiple parts that need to be welded together. Now the Model Y has just two parts that's just, welded together. And soon, starting in Austin, now with that gigantic die casting machine, the entire thing is just one stamp. So it's just one part, so it just eliminates so many steps, and that saves on cost. And that's how they can continuously drive these costs down, both on vehicle innovation, factory innovation, and battery technology innovation.
Yeah.
So that's going to continue, I believe. So we took a pause right here, as you can see on this chart. It's been paused right now for the past year, since we've just seen incredible macro changes. And this has been happening across the board for all manufacturers, not just Tesla. But costs have actually risen for the most part. And so that's the same thing that happened with Tesla, just insane demand outpacing supply. And so naturally that leads to, prices rising. But I believe that prices are about to fall once again, starting most likely in Q4, but, more confidently in Q1 of 2023 is when I believe that this chart is going to, once again, dip below that 50K mark.
And what do you say to people that, because I look at January 1 and I think immediately tax credits, $7,500 to every consumer. And that just rings. And to be fair, I'm actually more on your side on this. I've fought people on Twitter about this with like, look, the Model 3 long range is like 57,500 or something before they stopped taking orders. If all they did was drop it a couple $1,000s, it would now qualify, and then consumers would get an additional $7,500. Like it would be like a net 10K effect to consumers. And people fought back and forth with me and said, like, look, why would Tesla ever do that? Why would Elon ever do that? It doesn't make any business sense. But do you think, of course, there's going to be way more demand starting January 1 once Tesla starts qualifying these cars? What are your thoughts on, lowering prices into that? Because a lot of MBAs and business professionals will tell you that makes zero sense.
Yeah, that's the one caveat to that. That is the one sort of thing that could possibly keep, selling prices high for Tesla. So that would, again, depend on how big the backlog is. So if the backlog starts to ease, right, then it would make sense for Tesla to start, cutting prices. But if the backlog were to rise, then again, backlog is the ultimate indicator for prices, right? So if they're, the bigger the backlog, the higher the price. The smaller the backlog, the lower the price. And backlog is affected by, two things, right? Supply and demand. So, as supply starts to increase out of Gigafactory Shanghai, but also out of Berlin and Austin, we still haven't seen those two factories ramp up just yet to significant volume. So if that starts to work its way into the system, then supply will be, much higher, be more in line with demand. And once again, that would provide some easing the pressure on prices to rise. So, I still think that at some point next year, we will start to see prices start to fall. And that could be accelerated by the way, with recession. We're already seeing, prices across the board drop in other areas, and that's due to sinking demand. If you look at, for example, the price of, I just retweeted this, but the price of shipping a 40-foot container from Shanghai to LA, hit crazy levels. Just about 6 months ago. Here's the chart. This is the chart. This is the price of shipping a 40-foot container from Shanghai to LA. Before COVID, it was just hanging around $1,500. And then we had this epic rise, to almost, 12K.
Yeah.
And that's partly due to the backed up, shipping ports at LA. But now some of that is cleared. So that's been, putting pressure on prices down. But what we're also seeing is that a lot of these containers are being shipped, half full now. So there is clearly both a resolution of the supply side, but also, a downtick on the demand side. So again, I view this as a leading indicator for demand, and that's a reflection of the general economy.
Mm-hmm.
So as for example, unemployment starts to tick up, as just in general, the Fed continues to hike rates, that incrementally destroys demand. That makes the cost of financing your car higher. This is all incrementally, killing demand here and there. Not saying
Yeah.
that Tesla has a demand problem. I'm just saying that Tesla will have a demand problem at high prices. But once they
At
get
scale.
at scale, correct,
Yeah.
at scale.
Yeah.
There's only so many premium cars that can get sold during recessions or even during boom times.
Yeah.
The mass market is at that, under 40K level. That's where the true mass market is. In fact, they did a study that found that maximum revenue, that means total deliveries times average selling price, is achieved right around that 35K mark, and that's why they originally wanted the Model 3 to get to that $35,000 price point, because that's where you can maximize revenue. Prices lower than that, certainly you get more in unit sales, but less total revenue.
Yeah.
So to maximize that revenue, 35,000 is typically the sweet spot, and I think we're heading back there in the next 6 months to 12 months.
Interesting.
Yeah.
And I guess kind of the elephant in the room at the moment is like, okay, the markets are kind of in back to like June lows. Tesla's earnings Q3 are still going to be obviously record breaking in terms of gap, non-gap, whatever measurement you want to take. Um, Everyone wants to look at the stock price, of course, as a PE through the proxy of the stock price, figuring out what is fair, what is not fair, what's Tesla's earnings lining up for. I watched a video on your plant stock channel with you when you went through pre-split $1,600 a share, kind of looking at just EPS for the 2022 fiscal year. Let's talk about PE and PEG ratio, where you see Tesla in terms of earnings growth, let's say 2022. And then more importantly, for everyone, once Austin and Berlin really ramp up, where that really operating leverage can come from those new two factories.
Yeah, that's again, Tesla has been a beast on operating leverage, right? So that means, obviously Tesla, being a manufacturer of cars, factories are quite expensive to build. So there's a large fixed cost component to Tesla's cost structure. But that just simply means that, once they ramp production and inevitably deliveries, there's a lot of fixed cost absorption that comes into that. So what does that mean? It means that earnings are going to grow faster than revenue for a very long time, at scale, that is. So as long as Tesla can continue to scale and sell more and more cars, revenue growth is going to be right around that 40%, mark for the next several years. But earnings are going to be even higher than that. So you're going to see earnings come in at just ridiculous numbers, 60%, 70%, possibly 80%. If they can get an uptick in the FSD take rate, for example, that won't have a big impact to revenue, but it's going to have a massive impact to earnings. Because FSD is pure software revenue, so therefore it's very high margin. That goes straight to the bottom line. There's very little incremental costs associated with that. So, just not even considering FSD, but just based on the auto business alone, right? I see Tesla, reaching, a $2 to $2.5 trillion, market cap in the next 5 years.
Just the car business,
Just
not
the car
including
business alone. Yeah, just the car business alone, 2.5 trillion market cap. So that's, what is it, right? From compared to where we are right now, that's like almost a 4x from where we are today. So,
and that is that based on, I know your model is cash flow, a multiple off cash flow, but well, like for people that are trying to understand where that valuation may come from and what assumptions you're taking, because every model has their own assumptions, what can you cover that a little bit for us?
yeah, so like if you just look at the Tesla's operating cash flow, like I like to model especially companies like Tesla, which are very capital intensive. I like to model them on operating cash flow. A lot of people like free cash flow, but I think operating cash flow is better, just because, free cash flow, it's net cash from operations minus capex, right? Now that penalizes companies that just simply elect to invest, right, in more factories and more production. So rather than looking at free cash flow, I think net cash from operations, otherwise known as just cash flow, is the right number to model, Tesla. And on that number, I see Tesla hitting, $50 billion in operating cash flow, right? So right now, just to put that into perspective, over the past 4 quarters, Tesla's did about 14 billion in free cash flow. So, I see that, multiplying over the next couple of years to 50 billion in operating cash flow. And, if you put just a simple 50 multiple on that, which I think is very reasonable because of the growth rate, but more importantly than just the growth rate, this is something that more people really need to understand, is ROIC.
Okay.
So studies have shown, and this is something that Buffett and Munger have talked about their entire lives, right? Warren Buffett, this is their guiding principle on investments. Same thing with the greats out there, Peter Lynch. There's this other guy, Terry Smith, that I follow. He manages a fund called Fundsmith out in the UK. Great performer, just market-beating performance over a very long period of time. They have been able to do this because their focus is on return on invested capital almost as much as just pure growth. So growth is what everybody talks about, but companies that grow, that's only half of the picture. For example, let's say you have 2 companies, both are growing gangbusters at 50% per year. Let's say both start off at the same, PE multiple. Let's say they both have the same amount of risk. They both have similarly talented management. They both, are of the same size. Let's say everything else is the same, right? Everything is the same. They're growing at the same rate. Everything else is held equal. But one company, in order to achieve that 50% revenue growth, has to spend, let's say, $1 billion for every, $100 million in incremental revenue growth. And then company number 2 has to spend, $1 billion for every $150 million of incremental revenue growth. Then company number 2 is going to be the one that outperforms. Why? Because they get more revenue per dollar of investment that they have to put in, right? And that's the principle of ROIC. What's the rate of return that you're generating on the investments that you deploy? So in Tesla's case, what are their investments, right? Their investments are gigafactories. Their investments are, battery factories, car factories, superchargers, service centers, their solar, manufacturing, their battery storage, all of their costs associated with that. That's their investments. And then what's their free cash flow on those investments? So companies that have high growth definitely trade at high multiples, but companies that have both high growth and high ROIC trade at an even higher terminal multiple. So let's take a very simple example, Coke, right? Everybody knows Coke. Now, Coke grows at like 3% per year, right? It's not a growth stock at all. They grow just year in, year out, 3%. It's not a very exciting company at this point, right? It was 20, 30 years ago, but not anymore. But Coke, for some reason, trades at 20 to 25 times on a PE multiple basis. That's high, right? That's actually higher than the market. And yet they're growing slower than the market. So why is that, right? And it's because Coke is a durable business. That's one. That means it has very low risk. That means they have low cost of capital. but also because Coke is a very high ROIC business. They generate returns on capital of nearly 20%, which is high, right? That's pretty good. So they're very, very capital efficient with the way that they conduct their business. So because of that, the market rewards them with a high multiple. Whereas other companies are growing faster than that, but have a lower multiple, like Facebook. Facebook actually trades almost at the same multiple as Coke, right? It's actually amazing how that is. But Facebook was growing at 20, 30% for a long time, for the past decade. So this is why there's a difference, right? And it's partially because Coke has been around for 100 plus years and Facebook has only been around for 15 years. So we don't really know what the future of social media is going to be, whereas everybody drinks Coke all the time across all cultures. So again, back to the idea is that, companies that have high return on invested capital have, higher terminal multiples. So what's Tesla's, return on invested capital? We can see that in this chart, right here, where we see this rate of change right here. So this is what I call their cash ROIC. So here's the spreadsheet, the underlying data behind that. All it's doing is just taking free cash flow summed up over the last 4 quarters, right? I also subtract any dividends that the company pays for, and Tesla doesn't pay dividends. So retained free cash flow means their free cash flow minus any dividends paid. That's how much free cash flow they generated over the past 4 quarters, right? 7.8 billion. And then I look at their invested capital, right? This is the total amount of money that has been deployed cumulatively since inception. So that is basically your total assets minus your current liabilities, and then you do an add back for any current debt that the company has. So you're basically adjusting for net working capital in this case. So it's basically long-term assets plus net working capital. And in Tesla's case, as of Q2, that was about 48.2 billion. And then I just take a 4-quarter average, since investments made today, they don't really show results immediately, right? Investments that you make today play out over the next year or so. And so I take a 4-quarter average of the last of these last 4 invested capital figures, and that gives us 20%. So Tesla generates 20% on average over the past 4 quarters in terms of free cash flow relative to the average capital base. That is very good. But what's also important is the rate of change in that number. So for years, obviously, Tesla was burning cash. So ROIC was negative. And that flipped positive, in I believe it was Q2 or Q3 of 2018. Yeah, it was Q3 of 2018. And it's been improving ever since then. So this is basically Tesla showing that for every incremental factory, right? Back then, only Gigafactory, Fremont, really, the Fremont factory was the only factory that was pumping out cars. And then Gigafactory Shanghai came along, and now Gigafactory Berlin and Austin are coming along. So you can see that Tesla's been getting more and more efficient for every dollar of capital that they deploy. And this is the ultimate calculation, by the way. This is free cash flow. It's not, adjusted EBITDA or, let's add back X, Y, and Z expenses. No. Free cash flow is the ultimate bottom line for any company.
Yeah.
So that is the number that I'm using here. And even according to that number, we're at 20%. No automaker in the world. Toyota has always been the standard bearer of automotive manufacturing efficiency. They're not at 20% or anywhere close to that. Last I checked, you have to remove their financing arms to really understand what their automotive arm is doing. And their automotive arm does about 12% ROIC. So Tesla is already at 20, and that's before Gigafactory Austin and Berlin are even fully ramped yet. Because keep in mind, those two factories are already counted in today's invested capital base, right? Because they have to show that as a part of their balance sheet. But because they haven't ramped yet, the free cash flow, which is the numerator, hasn't actually reflected that yet. So we have 20%, which is almost twice as high as Toyota, and that's before those two factories have even started producing it.
Yeah. And those factories are supposed to have 4680s. Those factories are supposed to be single die cast. So they're pretty much like the state of the art in terms of margin enhancing. So, I mean, you could make a case maybe for ROIC to approach Apple's in the next couple of years and maybe even pass it by, let's say, the next 5 years. Is that fair?
Yeah, I'd say I actually put out a tweet on that, and I think actually that was a video I did with Gally. And what was awesome is Elon actually replied to that, and he said that he basically said that it's likely that it could likely happen. So that's a tall order though, because that means that right now Apple. Let's look at Apple actually. I haven't looked at their numbers lately, but the last time I checked, that was. They were at 40% plus on ROIC. I got to check it now here using my handy.
This is a crazy Excel sheet. Look at how legit that is. You just threw in the ticker, hit refresh, boom.
Yeah,
everything's there.
So yeah, I built the spreadsheet using an Excel plugin that I have through my employer. I work for Zacks Investment Research.
Oh, okay,
so this
cool.
is something that we offer as software for
That's sick. Look at that. Wow.
But yeah, look at Apple. They're almost basically at 40% ROIC. So Apple has just been incredible. It used to be even higher actually.
Right.
But here's the caveat with Apple though. If you look at this chart, 40% is definitely amazing. But look what's been happening to invested capital, which is the denominator, right?
Right.
So for years, Apple was in ramp mode. This is basically what Tesla is doing right now. They were investing rapidly in R&D, in production, in manufacturing capacity, right? So this is their balance sheet expanding, right? That's all going towards their investments that they're making into themselves. But then ever since this inflection point, which was Q4 of 2017, the balance sheet has actually been in contraction. What this means is that now you can say that Apple produces more free cash flow that they know what to do with. So that means that they are buying back stock and paying out dividends in order to reduce the size of the balance sheet. So their dividends and buybacks exceed how much capex that they're spending, right?
But that's essentially a signal to the market. Look, we don't know what to do, and our growth story is on its tail end at the moment, unless they pivot into the metaverse or something.
Exactly right. Yep.
So that's interesting, and this is world class, world leading, right, in terms of mega caps for ROIC. Is that right?
Yeah, that's correct. Now, Apple doesn't do all of their manufacturing themselves, so that that does help with the ROIC there. Obviously, they go to Taiwan Semi and others to do some of that, or Foxconn, I should say. Other companies like Nvidia, they go to Taiwan Semi to manufacture super high end semiconductors. And Apple's doing their own semiconductor manufacturing now, so that's interesting too.
Yeah.
But the better comp, I think, for Tesla would be Taiwan Semi, right? Taiwan Semi is all manufacturing, and they are considered the world's behemoth when it comes to manufacturing efficiency as well. No one can really beat them in terms of how efficient they are with regards to generating cash for every dollar of capex that they put out there. And Taiwan Semi, I believe Tesla just passed them as well. So we can just check that out right here. Yeah, so Taiwan Semi is at 14%. So, and that's considered world class, right? Because no one can do what Taiwan Semi does with regards to, I think they just introduced 3 nanometer technology, semiconductors, which is just insane. Nobody else can really match that. And so they're at 14%. You can see that they've been ramping investments quite aggressively here.
Oh, well, yeah.
So this is, no one can beat Taiwan Semi at what they do, and they do it quite well. But you can see that Tesla has even surpassed them, from a free cash flow to invested capital, standpoint.
Yeah.
So this was my long-winded way of just basically explaining as to why I think Tesla will always have, a high multiple. And that's because that, they're going to be growing quite rapidly for a very long time. There's a very long runway. Electric car adoption right now is still under 5% in most developed economies. And that means that number is just, going to increase even more, especially as Tesla rides that cost curve down, right? If that continues to happen, that's going to drive even more adoption. That gives a very, very long runway for growth. But also at the same time, it's high efficiency growth. What's been happening, for example, over the last year, all these stocks got slammed, right? Because despite growing rapidly, and that's because they pursued growth at all costs, sort of,
Right.
But Tesla's kind of on the opposite side of that, where they have growth but high efficiency to go with it.
Right.
So if you have both of those, you have a pretty high exit multiple. And so I think a 50 multiple to operating cash flow is very reasonable for a company of Tesla's caliber.
And as we sit here right now and we talk about Tesla, and everyone is kind of wondering, okay, 241, by the way, 241.20 sitting on Tesla at the moment, finally agreed on the day. Everyone's kind of wondering, okay, the PE, I think the trailing 12 PE might be like 60, the forward might be like 80, something like that. It's sub 100 now. Tesla was trading at, monster PEs before that. How low? I mean, no one really knows short term what can happen, what Elon tweets out, of course, and what force majeure is next in the world. Hopefully not. But like, what's a bottom of the barrel, let's say, forward PE that Tesla that we can pull from maybe from like an Amazon story or some other typical growth story that Tesla's kind of analogous to, and kind of look at the PE and be like, this would kind of be like the bottom of the barrel, or maybe do you think that we're kind of there already?
Yeah, so you could use a couple of different ways to think about this. You can use PEs to find out what the bottom might be, but I think the better way to do it would actually be on an EV to EBITDA point of view, because Tesla doesn't have a lot of earnings history. It's only been about 2 years, a year and a half since earnings flipped positive. Free cash flow was earlier than that. But if you switch over to EV to EBITDA, right, it's a lot clearer because EBITDA has been positive for a lot longer. And this is a chart right here of Tesla's enterprise value to EBITDA using forward EBITDA estimates. This is coming in from analysts. And this is really interesting because you can see that Tesla right now trades at 25 times forward EBITDA. That takes us all the way back to the middle of COVID, early 2020. So, one, very short-ended way of kind of using this is to take that midpoint, unless if you think we're really headed to the bottom of COVID, right? That would be a pretty sizable downside from you, because at the very bottom, Tesla traded at 13 times forward estimates.
And that was when Fremont was shut and Shanghai was shut, right? Like everything was down.
Exactly. So we're nowhere close to that. So I think we're getting close to a bottom. I mean, I think unless if there's macro, right? Macro could take us down further, but I think there's going to be at some point, a rush of buying coming in to defend it. Another thing that I think that you're going to see with Tesla though is that there may be downside with Tesla stock. Definitely not putting that off the table. But what's going to happen is, I think analytically, there's going to be a situation just like what happened with Amazon, Apple, and Netflix in 2008. If you study those charts from back in 2008, back when Lehman broke, right, the market was in free fall, everything was crashing, no matter who you were.
Right.
But true growth companies who barely even experienced a recession in 2008 themselves, right? Stock prices were all down, but revenues were up for Amazon, Apple, and Netflix. They actually grew revenue by 30-40% year over year, right, during that year. So what happened to their stock price is that it initially tanked with the market, but it bottomed out early on. And then while the market continued to set new lows into March, Amazon, Apple, and Netflix, these are just three examples. There's probably others too. They all bottomed out by December of 2008.
Okay.
So 4 months in advance, they bottomed out, and they refused to set new lows after that. So this is something to watch out for Tesla. I think that's going to happen with Tesla, where if there is a market flush, Tesla will go down with it. But it's going to set some low point and never truly return back to that. So if it does that, that's how you know that Tesla is going to lead to the upside when the market is finally done selling off.
And of course, in the middle of all of this, like interest rates are kind of night and day from where they were, let's say, even in Tesla's IPO history. I think that's probably a fair assessment, or they're at least going to be there. So how does that affect your weighted average cost of capital in any of your valuations? Do you care about that at all, let's say in the next 2 or 3 years, or because Tesla's debt so low and Tesla's kind of in a league of its own, you don't really weigh it as much as an equity risk versus other stocks?
Yeah, no, so the beta is high. A lot of people like to look at beta and kind of come up with the cost of capital. I'm not really in that camp. I think that's too academic. I think in practice, the cost of capital is a function of how is the bond market pricing your credit, right?
Okay.
So your cost of capital is very low. So this is the other reason why I don't really think this S&P upgrade is really that big of a deal, is because Tesla's bonds were already priced like investment grade credit anyway. So the bond market already saw this from a long time ago, along with the rest of us. And they decided, all right, well, we don't really care what Moody's says. Tesla is pretty low risk in terms of, for bondholders, that is. So, you can look at Tesla's bonds and look at and say that, look, they've got a very, very low, cost of debt. It's not often that you see companies with very low cost of debt and very high cost of equity. So, I like to look at the bond market and just look at, how are Tesla's bonds trading? What interest rate and what spread do they trade at relative to, say, the 10-year yield? And use that as some approximation. And so I think as Tesla diversifies their manufacturing, right now the main risk for Tesla is that they're too concentrated in basically one factory. They're dependent on Shanghai right now for most of their production and more importantly, most of their profits. That's where the majority of their profitability is coming from, is Gigafactory Shanghai. So there's a little bit of political risk, which adds to the cost of capital, right, currently. As they build more factories and get off that dependence, and then as they diversify their product mix, maybe energy starts to contribute in some meaningful way. It's been dead for years. Hopefully that wakes up at some point. That would be great to diversify the business away from just cars. And FSD, that would be a huge de-risk, right? If FSD starts to pick up in terms of the take rate, that's a brand new source of income, high margin income. So again, there's ways that Tesla can reduce their cost of capital. And it's already in the roadmap as it is.
Have you tried FSD or FSD beta at all? And do you have any thoughts on it?
Yeah, I just tried it actually 2 weekends ago.
Okay.
I was blown away. So I live in Baltimore. So I was checking it out in Baltimore, and I went across town without a single intervention. And that was through there was a lot of pedestrian. That was through a crowded area, through the nightlife area, where there's lots of bars and shops and stuff. Lots of people crossing the street. It handled it perfectly. So that was the first drive. The second drive I did have to take over twice. So, it was a little bit of hit or miss, but I think in general, it looks like the rate of change is very impressive. I think it's a matter of time before they solve it, right? Before they really solve it. So Now, getting it to being reliable all the way up to getting it to be able to be fully driverless, that might be a while.
Mm-hmm.
But if you're a long-term investor, I mean, if you're in it for more than just a year, if you're in the stock for at least 4 or 5 years, I think you're going to get it at some point in the next 5 years.
Yeah, and I think, by the way, I think a lot of people like misconstrue what Elon says about FSD by the end of the year. They think he means level 5 robo taxis everywhere. I think we've got to tame expectations there. He's pretty much saying anyone that isn't that has FSD can now get FSD beta. And that's all it is. There's no more safety scores, no more jumping through hurdles or proving yourself. If you paid for FSD, you can at least try it. That doesn't mean it's done yet. It's still in beta.
Yeah.
By the way, you talk about return on invested capital. I mean, FSD and software subscriptions there, fully recognizable, pretty much straight to the bottom line, no variable cost. It's just, and that's not even like your modeling is really just focusing on car sales anyways, right? So it's just such a big boon to look at in the shorter term or in the longer term.
Yeah, absolutely.
I'd be remiss if I didn't mention it. Everyone that's been trying to get you on has been trying to get me your opinion on Tesla Semi. What do you see in Tesla Semi? Like, there's two sides of this argument. One is it's totally revolutionary. It's going to train. It's really going to it's going to change transport and logistics. And the other side of it is like, okay, it's a higher ASP vehicle, and that's pretty much it. And their cap of vehicles that they can sell worldwide at any given year is really not that high. Sure, maybe earnings is great, but it's really not revolutionary. Why are you more in the, oh, wow, we are skyrocketing here. Look at this, 242.85 sitting on Tesla. It's quite the jump. Why are you more in the former category? By the way, I am too, because I think it's a whole, I think it's going to revolutionize logistics. But why are you in more of the former than the latter in terms of the Tesla Semi argument?
I have been trying to get a movement going to not much success. That I think that if Tesla is serious about FSD, if Elon thinks and is convinced that fully driverless technology is possible in the next 5 years or so, I think that the Tesla Semi will be Tesla's number 2 gross profiting vehicle program, ahead of the Cybertruck.
Wow.
And everyone is excited about Cybertruck, and again, that's because they're going to be able to buy it, right? It's a consumer product. It's not a B2B product, right? But the Tesla Semi, if you can fully solve driverless technology for a Class 8 semi truck, and if you can get the battery technology right to be able to achieve 500 miles, at least 400 miles, while hauling 80,000 pounds of weight, right, which is what semi trucks are supposed to do, then we will see a revolution in logistics globally with the Tesla Semi, where the ASP for the Semi could be 500K, 600K, 700K.
Wow.
Because you're replacing not just cost of fuel and the cost of maintenance, but you're also replacing the cost of the driver, which is the biggest cost for truck companies globally. And if you look at the data, there's a report that Deloitte published a few years back, and they found that roughly 1.5 million Class 8 semi trucks were sold in 2014, and that's expected to hit 2 million globally by 2025. That's a pretty big TAM for a truck that can fetch, say, $500,000 per unit, which would happen if Tesla FSD is solved, for semi trucks. And by the way, I think driverless technology is actually more achievable for the Semi than any other vehicle, because semis log most of their miles on highways.
Yeah.
And Tesla Autopilot is already great at that right now.
Yeah.
It's been great at that for a couple of years now with the Navigate on Autopilot software. It handles highways perfect. It handles taking exits perfectly. It's just the city streets that's been the main challenge.
Mm-hmm.
So the semi-truck is perfect for being Tesla's very first driverless vehicle.
Mm.
They can figure out the charging side of things.
Yeah.
And then just the last mile, which is the trickiest, right? Just getting it off the highway and then to its,
Yeah.
ultimate destination. That's the hardest part.
Mm-hmm.
But this is a market that is just enormous. And, the cost of building a Tesla Semi is probably going to be, I'm just guessing around 140K if you, count the total cost of the battery. And they want to sell it for 180K. So about a $40,000 gross profit per unit, which is not a lot, because it's a very low gross margin compared to the Cybertruck, for example, because the Semi is going to need maybe a 1 megawatt hour battery, right? Maybe even bigger. But if they can solve FSD, then the price of the FSD on the Semi is going to be much higher than the price of FSD on every other Tesla car.
Yeah.
Because of the market opportunity of semi-trucks, the form factor itself. So that's why I think if Tesla is serious about FSD, I can't see why the Cybertruck should take priority over the Semi.
That's a hot take.
But if you think that FSD is still a number of years out in terms of being fully driverless, then it makes sense to prioritize Cybertruck because Cybertruck is ready next year, for example. That's why.
No, I totally understand that reasoning. I guess the thing there would be, is FSD, is autopilot the way that it's configured right now? Because in a car, in a truck, you're going to be in a semi, you're going to be driving very differently than you're going to be driving in a passenger vehicle. Like your turns are going to be wider. You're going to go through 2 lanes oftentimes to make a right turn or a left turn. Like it's going to be different. So that's a great question, actually, in terms of the specifics. And actually, Paul brings up a great point here: megacharger interstate network with warehousing. And immediately I think about Tesla Bot as a part of this. Like it totally fits hand in glove there with the last mile portion that you're talking about.
Yeah, that's an option as well. If they can just take an exit and just have somebody ready to take over for the last mile, that's a huge cost savings overall. Like, and you don't have needing to take breaks. You don't need to, worry about, accident. Like, first of all, the safety technology is already better than most trucks out there. It's just a complete game changer when it comes to logistics. And it's the first product that would actually move the GDP of countries. I've said this before, but you would have such a deflationary impact on transportation. That would reduce the costs embedded throughout supply chains of the world. And yeah, it would kill jobs, right? It would kill trucking jobs. That's definitely for sure. But every industrial revolution has killed jobs of some sort, right? But society has been better off for it,
If anyone has any questions, feel free to throw them in the chat. I got a couple starred here in the meantime. I want to respect your time. The one last thing of a just general broad topic. You can go as specific as you want on this, Mayur. But 2023 Tesla fiscal year, let's say deliveries. What sort of earnings potential do you think next year brings? Just so we can get kind of a lay of the land because 4680s are pretty crucial for next year. The battery mix is going to be crucial. Where do you kind of see everything falling as it stands today?
So you mean for next year, the expectations for earnings for next year?
Mm-hmm.
Yeah. So, if you look at it in terms of just GAAP earnings, right? Over the past 4 quarters, Tesla was around 9 billion, 9.5 billion over the past, 4 quarters. It's hard not to get excited with regards to Austin and Berlin ramping up, as well as Cybertruck starting to contribute to production and deliveries next year. It's hard to envision. It's really it sounds overly optimistic, but I think next year, man, they could be at 15, 16 billion in earnings just because of the operating leverage that we see. So that's a doubling of earnings from
Is
over the
that
last 2
gap?
years. That's GAAP, yeah, GAAP earnings
Okay.
per share. Well, GAAP net income.
Right.
Right.
Okay. That's like the bottom. That's the bottom barrel, bottom line. No arguments made here about anything.
Yeah.
Yeah. I was
Yeah.
looking at James Stevenson's Excel spreadsheet with his or icon underscore enough. And on YouTube, he's looking at. I was nerding out on some of his Excel spreadsheets, and I think next year he has adjusted EBITDA over 30 billion, under 40, I forget. It's just crazy where the next 12 months could lead in terms of earnings potential for Tesla. It's just like today is much different than it was 2 years ago, where there was, we were every quarter we were debating if it's going to be profitable or not on a GAAP basis for S&P inclusion. And like just a year from today, it could be at this point where it's like, okay, now there's a actual short-term trajectory to beating, an Amazon with adjusted EBITDA or something in the next couple of years post that. So it's an exciting time to be analyzing Tesla, isn't it?
Yeah. There's no other large cap growth company that is growing this rapidly and trades at this multiple. So this is something Gary Black mentioned. So it's directly from him, but I can't find another, company that's at this scale that is growing this rapidly. You may have to look out to much higher PEs then in that case, or much smaller companies, but it's hard to find someone that's growing 40% revenue CAGR, 70% earnings CAGR for the next several years, not just 1 year, but 3 years, most likely, because next year will be the year of Cybertruck, but it won't even hit volume production until the following year. So that's yet another year of very high growth that we're going to see.
Yeah, what makes Tesla unique isn't obviously just the unit economics and the margins and whatnot. Those obviously matter, but it's the magnitude of the effect. Is like iPhones, Apple, great, but we're talking about a sub $1,000 product for the most part. Laptops, couple of thousand. Tesla at the same unit economics, but we're talking 40, 50, 60,000, and of course more per product. So it's just at a different scale altogether, and that magnitude allows them to venture into so many other projects, whereas other companies may not be able to. So yeah, it's exciting times for sure. And we'll get into a couple questions here now. By the way, just label them questions so I can see them. But Boyle asks, how long does Tesla have to start another factory to sustain their 50% growth? Or do you think they need to?
How long does Tesla have for what?
To start building another factory if they want to sustain that 50% CAGR over the long haul. Because a lot of people are saying, okay, look, Tesla really needs to get a couple more factories up and rolling because it's going to take 2 years, and maybe it's not going to be as fast as Shanghai, definitely not as slow as Berlin, hopefully, but it's going to take time. So do you worry about their 50% growth in perpetuity if Tesla goes another year or two without another gigafactory announcement here?
Yeah, and keep in mind that 50% growth it's not a hard line. So if they grow at 40% 1 year, it's not the end of the world at all. But more important than factories with regards to car production, the bigger there's two things that Tesla needs to figure out first. One is the 4680 program. Mm-hmm. That has been and continues to be the constraint in production. They can produce many more cars, like in terms of the frame of the car. That's possible for them to do, but they're not building for that just yet because they haven't procured enough battery supply for that on the 4680 format. So if they can figure out 4680 battery manufacturing at scale, and if they can get to that cost per kilowatt hour that they were aiming for on the original battery day presentation that they did, getting that down to $70, at the pack level for batteries, right? That would be the accelerant for additional vehicular gigafactories. So at this point, building gigafactories is the easy part, right? For building cars themselves.
Yeah.
The hard part is the batteries. That's one side of it, and then the other side of it is FSD. So FSD won't be the big driver for revenue growth because it's a small number relative to total revenue, but it will be the accelerant for earnings growth. And that's what ultimately matters for stocks, right? Earnings and free cash flow. So that would be the ultimate, in terms of accelerating. So even if Tesla were to say, for example, Tesla, moved, FSD quite well, and it suddenly increased the take rate of FSD from, I think the current estimates are like 8%. 8% of Tesla buyers are buying FSD, something like that, something under 10%. If that number goes to 15% or 20% on 1.5 million cars on increasing production, that moves the needle significantly for earnings growth. So you're going to see revenue growth, potentially maybe slow to 30%, maybe, if they haven't figured out how to increase battery supply just yet. But you would see earnings grow at 100% year over year. So it's possible for revenue to slow down, but earnings to accelerate, and that's dependent on FSD development. More people start to see the value of FSD, and the take rate starts to increase. That's the other big accelerating factor for earnings growth.
Yeah, it's almost like a safety net to batteries is let's just solve FSD and all this doesn't matter for now. Next question from Blake. Once Twitter deal completes, is that a positive or negative for Tesla? Yeah.
I don't think it's a positive, I think that some people are concerned that it's going to take up Elon's time, and I don't think that's going to happen. Look, Elon has other companies too besides Tesla. He seems to handle them quite well, and for SpaceX, he's got Gwen Shotwell, who's been amazing. By most accounts, she handles most of the day-to-day stuff at SpaceX and others like that. So I think he's going to do the same thing for Twitter. He's going to find a CEO. I don't think he's going to be the CEO for a long time, maybe just for a short while, but he has done a pretty good job at delegating. I know a lot of stuff he likes to take hands-on by himself, but he's selective with that, by the way. So he's selective on what things he takes on himself.
Yeah.
So maybe he does do stuff with Twitter, but I think he's not going to handle the day-to-day stuff.
No.
Someone else is going to do that. So I'm not concerned about that at all.
Yeah. Yeah. I mean, the guy that balances like 4 or 5 different multi-billion-dollar companies, like, I don't think I have to worry about his time management, really. Paul's asking, would be curious to get your take on energy and what the actual potential short and medium term, let's say, benefits may be.
Yeah, energy has been the big frustrating point of Tesla, right? We had the solar roof product, which was an awesome. Well, even before that, just in general, the solar business is tough. Solar is essentially a commodity business. And it's a very low gross margin business, which means it's a very low ROIC business. So the only way for solar to be attractive for a company is if they can pair it with software that generates margins, right? Or pair it with something else that makes up for those lost margins. So Tesla tried to do this by, I believe it was at some point last year. I can't remember which quarter it was. I think it was like Q2 or Q3 of last year. I think it was Q2, where he's like, all right, well, from now on, we're not selling solar by itself anymore. And that was obvious because, again, solar by itself is very low gross margin. But we're going to pair it with Powerwall, and Powerwall does have really, really good gross margins. So that helps, but we haven't seen solar contribute to earnings since inception, right? The original Solar City plan has basically been dismantled.
Yeah.
And then Elon launched the solar roof product, which was a great idea. In theory, it actually solves the problem of low gross margins by killing 2 birds with 1 stone. It also improves the ROI of the customer. So it makes everybody happy. Customers are happy because they have, they actually end up saving money if they need a new roof in addition to solar. And Tesla's happy because they get to increase their gross margins and charge higher prices. But Solar Roof has gone nowhere, really, in big numbers. And the big limiting factor has been labor.
Yeah.
So it's just taking a very long time for installers to install it. So it's just hard to scale this product.
Mm-hmm.
So I haven't seen any evidence of that really ticking up. We did see gross profit wake up for the first time ever this past quarter. So let's see if they can turn that into some momentum.
Mm-hmm.
But
Yeah.
as of right now, Tesla Energy is kind of this dormant side hustle. It's kind of a side hustle at this point, you know.
Yeah, it's a loss leader.
What
Yeah.
they do with auto bidder too.
Sorry, can you repeat that?
What they do with the auto bidder software, right?
Mm.
And the virtual private network, virtual private, power
Power
plants, that
plant.
is,
Yeah. Yeah.
the VPP. That's pretty cool stuff. So I
Mm-hmm.
don't know. If they can figure out how to scale it, that's the key. But the key is to scale how many people are able to get Tesla Solar with Powerwall.
Yeah. And it's so important for the mission, even like, so I don't talk about energy too much. I don't put it in my modeling because I'm like, oh, it's kind of a nothing burger for now. But excuse me, but long term, it really is critical to the mission, to Tesla, to the world, really, that we figure out a way that we can scale solar so we don't have to get into part of the next question, which is geopolitical concerns. Germany, China, US government, this whole Putin, Elon back and forth with trying to be peacemaker. What do you look at geopolitical concerns like? And of course, you're no geopolitical procrastinator here, but where do you kind of see it for the markets? I guess is probably the better question.
Yeah, I've been tweeting this lately. Is that I'm getting a little concerned with China, and the problem with China is that people say, well, everyone else is in China too. Apple's in China. Everyone is in China. That's true, but it's a unique problem for Tesla right now because Tesla depends on China for the majority of their production and the majority of their profits, right? So Fremont is profitable, but Shanghai is significantly more profitable. So right now, Tesla is very much dependent on Gigafactory Shanghai to run basically, most of their business right now. So all this talk about earnings and cash flow and ROIC that I just mentioned, it all hinges on China playing nice with Tesla, right? If tomorrow we wake up and we see, China, for example, escalate their ambitions to take over Taiwan or something like that, and that leads to more that leads to more trade wars, and the Biden administration or even Trump or whoever's in charge, they slap on more tariffs and China does retaliatory tariffs. At some point, this is going to cause a problem with Tesla because China is like, all right, well, nothing personal, but you guys are an American company and it's time for us to send America a lesson. And they shutter the plant. Or there's the other side of the equation, which is that I think Elon might get in trouble with the Chinese. Elon's been very, very vocal about his free speech ambitions. And I think actually who was it? There was somebody from Chinese state media that just tweeted yesterday that they said something like he will regret this or
Yeah, I saw that.
Yeah, I retweeted it, but it's somebody from Chinese state affiliated media. They're saying, okay, here it is. Elon Musk has released his personality too much and believes too much in the US and the West's, quote, freedom of speech. He will be taught a lesson. So what does that mean? He will be taught a lesson. And this is coming from somebody that speaks on behalf of Chinese state media, which is essentially an arm of the government in China. So I don't like where this stuff is headed. I really don't. Look, China is a great country. It's a huge market for EVs. It is the biggest market for EVs. But the government is not reliable. And this is why, by the way, Chinese companies, pure play Chinese companies like Alibaba, Tencent, JD, right? All very popular US stocks, right? They trade on UX exchanges as ADRs. They all have gotten slammed. And not just that, but they trade at deep discounts to their peers. Like Baba trades at a very deep discount to Amazon, for example. They're very similar companies. But markets are assigning a much higher cost of capital to Chinese companies because of this growing concern with China.
That's a great point on the discount factor of the cash flows. The problem is, I guess there's no way for us to quantitatively know exactly what the mix is out of Shanghai for gross margin. I don't think that's broken down. Is it?
They don't break it down by factory, right? They don't give us that information. They just break it down by automotive versus energy.
Yeah.
But we can estimate it because it's they do talk about they do break down production capacity by factory. So that
But not
much,
margin.
but not margins, right?
Yeah.
But we can put 2 and 2 together and say that look, ever since Shanghai ramped up, we saw a big uptick in gross margins and net margins. So that's pretty clear that China is the driving force behind that.
This is a fair question from Paul. Paul says, shouldn't Q2 have been worse then if Shanghai was that far better than Fremont? And I think Q2 we were ex Zev credits gross margin was around 25. I think, don't quote me on that, 25-ish%. And that's a good point, actually. I mean, Shanghai was shut down for let's say 1 or 2 months out of quarter two. I guess ASPs were higher out of Fremont. The SNX mix was higher, so that could have made up for some of it. But that's a good point.
Yeah, so they also had some backlog that they were able to. They had excess inventory, I believe. So they were able to, make up for some of that. And even though the factory was shuttered, the factory was shuttered for half the quarter. So yeah, you're definitely right. But that's also to say that Fremont has gotten better too. So Fremont production has increased significantly as well. Model Y is being pumped out of there. Model 3. And then SNX, of course, as well. So Fremont has improved, right? So that's definitely, it's not to say that nothing else has changed, right? So Fremont has gotten better, and that's why they were able to deal with that shutdown so well. But if they were to burn off any excess inventory, and if Shanghai continues to remain closed, you're not going to see very high free cash flow production. And by the way, margins also improve because if the factory is shut, then so are wages, right? So that kind of helps with margins as well. But total free cash flow dollars, right? Earnings dollars, they suffer, right? And that's why we saw that dip from Q1 to Q2, in terms of net income.
Well, at least the good news here is it's only upwards from here as the mix starts to shift away from Shanghai, hopefully. We'll leave on this last question. Thanks for the super chat, Rex. Can you give a price target 2023 on earnings projection? Of course, not financial advice. Actually, Mayur has a really good video out on it, but I'll let you kind of talk through how you see 2023 and the price target that you might have for yourself.
Yeah, I think for next year, I'm not big on price targets because it's just a number. But just looking at how deep of a discount I think Tesla stock is trading at right now, and then given the prospects of Berlin and Austin coming online, 16 billion in net income next year. I think it could be even higher than that. If you just take my long-term terminal multiple is 40 times cash flow.
Okay.
But in the interim, it can obviously trade at much higher because we're still, in the early phases of growth. I really don't see why we can't take out, the all-time highs in Tesla stock at some point next year. So that would, target, a 400, price by sometime in the next, 12 months. And then I think it could get to 500 by the end of next year. So I think it could double by the end of next year. So it's a little bit more than a year from now. We're at roughly, 240?
240 at the moment.
240, yeah.
And that's based on, what assumptions again for earnings for next year?
Yeah, that's based on assumptions of $16 billion in earnings for next year.
Okay. Gap you're
Yeah,
looking at.
yeah, gap
Okay.
gap net income. Yeah, 16 billion.
Do you know what the
So,
street's at for next year for
um,
Gap? I know non-Gap they may be at $6, I think, non-Gap street, but multiply that 3, that's about 18 billion about non-Gap. So I'm not sure how much of a difference of stock-based comp there might be off of that, but
yeah. I'm just looking at gap. So yeah, they're like at yeah. It'd be hard to unpack that. I don't have that in
yeah,
front of me.
all good. No worries. No worries.
But
But they're lower than that. Is that
lower
fair
than
to say?
that on the gap
Okay.
base. Yeah.
Okay.
Yeah.
So 16-ish billion Gap. And by the way, why do you base it on Gap? I'm curious versus just doing it off non-Gap.
So it used to be better to do non-gap, but that was when the numbers were small, right?
Mm.
And so adding back stock-based comp, resulted in a huge difference.
Mm-hmm.
But now that Tesla has really scaled, it's you can really look at free cash flow and gap net income to just understand the business. Because now, by the way, since another reason for using non-gap is because of Elon's compensation, right? His big
Right.
bonus he got. Now that that's over, you can go back to using gap. So it's a combination of being at scale and Elon's bonus rolling off that you can start to use gap at this point. But I think the better number is free cash flow and
Gotcha.
net cash from operations.
Yeah.
Operating cash flow. Mm-hmm.
Awesome insight. And by the way, this is your career, right? Like you do valuations for a living. Is that right?
Yeah.
Yeah. So
I work as an analyst. Yeah.
it's great talking with you because you get to see and admittedly, like, I know very little. Sometimes I'm listening to you talk and I'm like trying to figure out what all the bits and pieces are, but it's great to get the perspective and the lens through what the street may be looking at in terms of risks, profiles, what metrics matter to them. Because I think retail investors, we try, we really do to figure out, but there is a degree of confirmation bias that we try to look at metrics that may paint our investment in a better picture than it is. So it's good to look at stuff like ROIC. It's good to look at not like, for example, you're looking at Gap where, I would never look at Gap, but that tells me that, hey, maybe I should pay more attention to Gap. So I appreciate you coming on. Thanks for the awesome insights. Hope to get you maybe back on again, maybe for a post earnings or some sort of debrief at some point. You're always welcome on.
Sure. Absolutely. Thanks for having me.
Awesome.
Appreciate
Thanks
it.
everyone for tuning in, and go follow Mayur if you haven't already. Link in the description for his Twitter handle. Take care, everyone.
All right. Thank you.